and we specifically going to be addressing the nexus between quality data, credit decisioning, and risk. And I think that's one of the subjects that have been addressed yesterday and today again in one of the panels. Joining us is Sharief Allie, who is one of the members of the governing board body at SACRA. Just to do a brief intro on him, he is a consumer credit portfolio specialist at the Foschini Group and has over 29 years of experience in retail credit and consumer data, focusing on lending, exposure management, and profitability maximization. He possesses a deep understanding of the credit life cycle, including acquisitions, collections, and provisioning, and its effects on consumers and governance. He has successfully managed seven large consumer credit portfolios in the retail, apparel, and banking sectors in South Africa and in the Middle East. And he's also consulted extensively for consumer lending institutions across the EMEA region, specializing in strategies for enhanced credit portfolio management through various data-driven approaches. From 2018 to 2020, he served on the SACRA Manco and is currently the data lead on the same governing body that I referred to a few seconds ago, promoting the strategic agenda of the data sharing ecosystem. Employed currently by the Foschini Group since 2011, he now works in partnerships and governance, addressing the rising global trends in credit regulation and information governance. He is passionate about leveraging data to drive economic growth in developing markets and nurturing the next generation of data-savvy credit problem solvers. Let's give Sharief a warm African welcome.
Hi everyone, just testing. Okay, great. Okay, there we go. So I think for the South African people in the room, you obviously know the Foschini Group is, right? It's a retail group. We do menswear, ladieswear, we do jewelry, we do home furnishing, sportswear, and so on. One of the latest things that we've done is we've signed a partnership with the JD Sports Group that also sponsors some of the Premier League clubs. Globally to promote sportswear in South Africa and through the SADC regions thereafter. So the topic that was chosen, this nexus between quality data, credit decisioning, and yes, it's obviously connected, right? It is obviously connected. I think from the previous slides and even when I looked at the topic, I think it was so easy to just say, yeah, well, if you have quality data, obviously there will be quality decisions coming out of that. So what I thought is, and I saw the slot, it's after lunch, right? So I'm conscious already that people are like, oh, okay, what's this going to talk about? It's just going to tell us quality data means quality decisions. Yes, I am. But I thought I'm going to actually just try to introduce some of the things that I've learned from consulting through the region, and especially in the retail market, which is the mass market of consumers. I'm glad about some of the content that came up earlier that spoke about the consumers and the important focus on consumers, because I think that's something that at times get missed. So I'm going to talk about why database credit decisions. It should be fairly obvious to everybody in 2024, but it will be less obvious for some people, especially if it's people that said, I know my business. And I heard some of that. I can build a scoring model that will predict somebody going bad or not better than bureau information. Is that somebody that believes in data? I don't think so. So I think it's important to break down those paradigms. I'll talk a bit about that. In fact, I'll show an example. We'll get into data quality. I've summarized data quality. You can summarize in a whole lot of different ways. I've chosen to summarize it in terms of accuracy and relevance. And then I'm going to talk about the credit life cycle. Because I think it's important that we talk about how the data is used, as opposed to just it's created and it's there. It's not just there if it's not going to be relevant somewhere. And then I'll just put some closing remarks in. Can everybody see that? So this is what happens daily with a credit provider. Credit provider is faced with people applying for credit. And this is how they position themselves. Yeah? You've got no information on them. Who would you lend money to there? I see no hands. Right, so we say, no, so I agree, we're not going to lend to anybody. Because we, to the women. The folks in the middle, those two in the middle are worried because they've got a power stance, right? They're defensive, they're not going to give their data to you. So you've got that, and that's effectively what we face. Is that, and in practice, unfortunately, the days are gone where somebody presents themselves to you in a personal capacity. So in the good old days from micro lending, people used to come into a branch, apply for it, you could look at them, you see what shoes are you wearing. Okay, I think this guy, he can afford it. That's what people used to look at, right? And now what we're looking at now is you see faceless customers, you see segments, you see data, you see an application for credit that's digital. You see pre-scrubbed information if you've loaded that in before the time. So now you're going to say, is the proposition easier or is it worse? And that's why I'm not surprised when people are saying, I know my customer. If you're a local lender in a community, you'll know everybody in the community and you know their circumstances and you probably have insight on data. The best data jockey can't give you that because you're from that community. So I think that's where the hybrid is. And my storyline will wrap up just now. So we need some data, right? Right, now we get the data. Can people read that? Yes, right, okay, so Magata can read it. I've got to see if I can read it. Yeah, right. Okay, so the first guy, I called him Adam. He looks very casual. Missed the last two, he missed the last two payments on his student loan. Okay, who would give credit to him? Caroline, you would? Oh, okay. If there was a student in the room, they'd probably say, yeah, give the, okay, you know what, he missed his last, he's going to make it up, I know him. Right? And if Adam was your son, you'd probably say, yeah, no, don't worry, I'll sponsor him. Right? Data that you don't have, but you're already looking at that. If you look at the next one, B is a part-time, she's part-time employed for now. So there's a regular income, but it's part-time. Would you lend money? And what I do with, when I normally consult to banks and so on, I ask them, would you lend your own money? Forget about the bank's money. The bank's got impairment budgets. The bank has budgets. They've got lending targets. They've got all the, would you lend your own money? Take your money out of your pocket. Would you give it to this person? Because if you're not going to do it, don't do it with the bank's money. And what are you going to base it on? Yeah? The next one, Colin, pays whatever and whatever and whenever he wants. You see, that's why I chose that one for the bloke. Because that's how we do. That stats that was quoted by Marina, thanks Marina, I know this from working long in the industry, that we have a saying among some of the analysts of that, we said men are dogs, because we were saying that they don't pay regularly. And in the retail sector where I work in, you find that men comes, how do we shop, guys? We go in, I need a pair of socks, right? Go in, buy the pair of socks, we walk out. Right? Magata, how do you shop? No, everywhere. There we go. All right. So in that time, what you're thinking is, I better pay my account. In the retail sector, I better pay my account because I'm going to shop again. Whereas men just go in, get a pair of, owes a balance, got something due, don't pay it. Yeah. So we've seen that plenty of times. The next one, Diane, striking a pose, always pays on time. Like Diane? Everybody like Diane? Everybody will always pays on time, always. Doesn't matter, COVID doesn't matter, she pays on time. Okay, the bloke next to her, Eric, says, pays ahead of time. He overpays. I've heard something about you take the loan out this morning and you pay it the evening. This is like you take the loan out and you take it with this hand and you pay it back with the other hand. So he pays ahead of time. Now, some bankers might say, oh, don't like that, eh? How do I make margin? Maybe you should just get a transactional card and savings account and that's it. Because I'm not going to make money off the profitability on the portfolio if I have a lot of people paying me ahead of time. How do I set terms? How do I set pricing and so on? Interesting one. Fiona pays every second month, and not to be related to the Fiona that I know that's sitting in this room. Sorry, I tried to choose names, man, and I couldn't get to F. You'll see it's A, B, C, D, E. Okay, so I'm an analyst at heart. So Fiona pays every second month. Is that a bad thing? We are so accustomed to say people must pay monthly. Is that just not a product mismatch, maybe? Let her pay every second month. Invoice every second month. Bill every second month. If that's what she can afford to pay. Greg uses credit to the max. and always pays the minimum. One of the beautiful dichotomies I sometimes come across with credit managers is they say, I'm not going to give him a lot of credit, he just might use it. Isn't that the point? And I've heard when I consulted through the region with people saying, no, Sharief, you can't give this out that much credit. And I said, but look at the scores, look at this. He's going to use it. Duh. Yes? Isn't that the point? That you want to lend to the better prospects so that they can achieve better in life going forward. So that is Greg. Okay? And Hailey, shame, severely delinquent 3 months ago. And now, exactly. And now what? Does it influence you what happens to Hailey now? If Hailey's up to date now, 3 months ago, scorecard theory tells you that what happened in the immediate past will happen in the immediate future. I put it to you that it says 3 months ago, which is not that long ago. So I owed you money 3 months ago and I dodged you. She was on maternity leave. Doesn't look like she was on maternity leave. Okay, so I think we get the story, right? So if we go through all of this, how would we rationalize all of these now? Okay, so typically what a bank would have is a bank would have a risk appetite. Credit managers might have a target that they want to disburse and that sort of thing, all based on budgets and forecasts and so on. Macroeconomic forecasters might say, listen, we have to get this level of economic activity. They might relate it back to GDP growth or movement in the consumer market. But effectively, this is what will be rationalized. And I've just taken some of those things and I put a simple RAG status. You're comfortable with the RAG status, red, amber, green, like a traffic light, to say, yeah, there's probably the two in the middle. We'll probably think they're green. If you're going to overpay me, I know it's safe. It's like investment theory. You're not going to put money into something. You're not going to get your own money out. Forget about the return. So if you're going to lend money, make sure you get your own money back first. All right? So in my full-time job, well, I should say my majority-time job, in the retail market, we lend money so that consumers can purchase merchandise. All right? So it's not a cash-based product. So those two in the middle, Diane and Eric, is probably, I think it's okay. I put a rank on as well for those people that understand what the ranks are. So I'll probably rank them number 1, the overpayer, number 2, the one that pays on time. And if I can maximize that sort of segment in my portfolio, I would have a great risk. Will I have a great profitability? Another question. Okay? Because if you give them the money over 3 months term and they pay you back all in month 1, guess what? How much money do you make? Not that much. But it took a lot of capital expenditure to do that, right? The amber ones are the ones that you are sort of in between. Okay? So you're not sure. That can go either way. You can say, I need more information, or let's underwrite them. I think people still do that. They underwrite them. They say, give it to a specialized underwriter. This guy's got the magic skills, and he's going to tell you which one is going to be green. Okay? And then you have the red ones, which you say, and typically, and that's just my shading based on what I know that some credit managers would do, is they say if you're delinquent in the last 6 months, it's a bit of a red flag. Let's wait till that last 6 months become the last 3 months becomes last 6 months. So I'll give you 3 months, so we invite you to reapply later. Okay? Or if you missed the last 2 payments on your student loan, they might say, listen, I don't care. A loan is a loan. A loan is an obligation. Now, I know there's compliance people sitting here. I also work in compliance. I hate it, actually. So the problem is, compliance people say, no, now you are, the X says you're not being responsible here. Where's your doctrine of responsible lending? And it came up in some of the discussions earlier, is that are you lending responsibly? Are we lending responsibly as a sector? Or are we irresponsible in our approaches? And that's the asset test. So if somebody says, listen, I'm struggling, you might have a strong view from a legal perspective or compliance perspective that says, Mr. Student Loan, guess what's the next one's going to miss? It's going to be the micro loan. It's going to be the salary advance. It's going to be whatever it is. Because it's bad habits, right? Okay. So let's get into why database credit decisions, and I think I've just illustrated it. So this is the theory. It's objective, it's independent, and it's consistent. Right? All of us would have made very different decisions based on what we saw before. One of the things that credit scoring does, for instance, it makes that for you an objective decision, and it makes it non-biased. Just because he supports the same football team as you do in the Premier League doesn't mean you've got to give him more points. You look at statistical fields and specific fields that gives you that information, and it doesn't always have to be a score. I know I'm going on about scoring because we're quite advanced with scoring in South Africa, but it can be rules-based approaches as well. Okay? A simple rule. can also be a basis for a policy. Then accurate data enables the following. You can automate your decisions, which is nice for systems people, IT people. You can automate it based around what you see in the data. For your scorecard developments, of course, you can file the information away. If you don't have a scorecard, it's not a train smash. Start storing your data today until you have sufficient data for you to develop a scorecard. If you can even get off-the-shelf scorecards. You can buy it off the shelf. I've implemented some of those in the Middle East, and it works well. And it's not that you have all the information. It's that you're putting something on the table that is an algorithm that says, this is how I'm going to score my market out and approve people. But once you get the results of who you approved and how they perform, that will be magic. Now you're building some intelligence on it, right? And I'm not saying roll it out to everybody. I say test it. Random selections for strategy testing, I'll talk a bit about that. I'll actually show an example of it. So the portfolios I typically work with in my career has been large portfolios. Okay, large portfolios, say in excess of 150,000 was the smallest portfolio I worked on, and then I worked to over millions. Okay, you can't look individually at an account. You have to set up rules to work on segments of accounts. And when you do random testing, it means you can set up your information. So that slide that Marina had is a good example. She showed the overall picture. Yeah, out of that picture, you could draw a random set, say of a population that's three months delinquent, and you can test something on them. And another random set that you do nothing with. So the one you send reminder messages out, and the other one you do nothing with. And you track it over time. The problem you always have is that people say, listen, if I do this strategy today, what is the result going to be in 3 years' time? You're not going to know. Unless you can forecast the economy to the T in 3 years' time, you can't. But what you can do is you can do testing on 2 groups that's of similar nature over the same period of time on a sampled basis, and then prove your point that this is a better proposition. I'll make a simple example. If I've got 2 random people, right, that I'm approving, or groups, or 2 groups, and the one I'm giving $100 to and the other one I'm giving $50 to when they apply for credit, how do I know which one is better? I let the 2 groups run and see who repays me, what's the default rates, what's the interest generated, and you can see where I'm going. It's the basis for profitability resolution. Okay, it's the basis for it. So on the one hand, you're going to have somebody in marketing shouting, I want take-up. In the product silos, they're going to say, I want take-up of my product. And the other one's going to say, the risk guy's going to say, whoa, but you're chasing up impairment. It's like, yes, we will chase up impairment. That's what lending does. If you lend well, you chase up impairment. You guys know that. Impairment must grow for lending to grow. Bad impairment you have to manage. But good impairment on up-to-date customers is a good thing. Okay? Forecasting and KPI tracking is important. It enables you to do this with data. You can set your KPIs. And I love working with credit managers that looks at their KPIs critically, not the result, whether it's still relevant. There might be another KPI that's very relevant at the moment. Number of buy now, pay later products. That might be a damn good secondary KPI to track now. How many of your customers have that? We don't know. Start tracking it. And accurate data is a confidence builder. Why? Because in a room always there's a few people that's going to fight over, I think we should do this and I think we should do that. Now if you have the data that backs it up, then obviously it's a confidence builder. And I put those 2 quotes on. I think you guys have read it already. It's just to convince you that, yeah, data is important. Okay, anybody disagree with those quotes? No. I think Charles used the first one with me though. Right. And then data is the new oil. It's valuable. But if unrefined, it cannot really be used. It has to be transformed into gas, and then it can drive real value. Now, gas, that's an American guy. Gas in terms of petrol or petroleum, saying that you have to refine it. Okay? And this is also touches on some of Sakura's mission statements. But basically, if you look at data quality, there's two ways to categorize it. I did is accuracy and relevance. And accuracy, got to be trusted source. I think somebody mentioned it earlier on this morning. The data must be from a trusted source. Don't let it be from a source. Is it a trusted source? Yeah. So you could have something as simple as you tell an IT guy, dump me all the information out of Excel or into Excel from your mainframe systems or whatever, and then he sends you the data. You don't know if it's trusted. He dumped it. The next time he dumps it, now we have more records. You just hang on. Why is this different now? And you find no. You see. That other system was down, so I didn't look at that records yet. Be very clear that you dump. So my best practice is dump everything. Get everything down there. If you don't have data somewhere in a manageable format that you can analyze it, get it all in. You can always segment it out. Cut out the ones that don't matter. Closed files, old files, deleted files, whatever. But get it into a single thing so that you can rationalize what your business is about. Trusted source is important. Consistency is important. You can't have a bank of new people capturing information and they capture it differently to what previous people captured it. Be careful. Be careful about fields that are defaulted. Time-based data must be on a specific time. Sometimes it's daily, sometimes it's monthly, sometimes it's fortnightly, sometimes it's annual, sometimes it's semi-annual, all these things quarterly. It needs to be what you need it to be. If you're doing a quarterly report for the regulator, make sure that your data is dumped and put into a format to ensure that a quarterly performance snapshot can be comparable. Okay? And comprehensive is the earlier point that I wanted to make. Is it must be everything. So one of the things I do typically when I consult is I said, give me all your data, give me all the records, everything. Then they say, oh, it's bigger than Excel can handle. I don't care. I work in SQL and SAS and it's fine. I want to see how many records there are. And if you speak to the CEO, he says, no, but we only have so many accounts. And he says, no, but you don't have so many accounts. You've got so many accounts. I didn't know that. Yeah, but these ones you see, these are deleted ones, these are old ones, these ones they delete, they took away, these ones they're not interested in, these ones are outside of the country, these ones. But it's sitting there. And think about data privacy and papaya or poppy, holding the information for an extensive period of time when you don't need it. Okay? It opens up those sort of questions. And on the relevant side is where I'm very passionate about the relevant side. Is it pertinent? Are you keeping stuff that's pertinent or not? I'll give an example just now. Is it valuable? Is it insightful? And does it navigate your decisions, most importantly? Or are you just reporting it because, hey, we all look at balances, so I guess that's the new thing. It must be relevant to you. If balance don't mean anything to you, then you just say, it's a secondary KPI and it's just a number. But if balance means something to you in terms of the profitability, the interest, the fees that you're going to generate, then it's an absolutely magic variable. Can people see that? Okay, let's see that quickly. So here's an example of data accuracy. I was relating to data source. Okay. Why do we get 25 customers is the question. Basically what I have is I've got a personal loan system with 20 accounts and 20 customers. I've got a credit card system with 20 accounts and 15 customers. And when I put the data together, I get 40 accounts, which seems to be the one plus the other, but I only get 25 customers. Anybody want to venture why I get that? I hear some mumblings. No? Shall I give you the answer? But can you understand what? This is what typically an analyst will sit with. So when you hire a hotshot analyst with a science degree, honors, cum laude, whatever, they give you this. They say, you know what, you've got 20 accounts there, you've got 20 accounts in the other system, you put it together, you get 40. I'm like, great, that makes sense. I say, but I got 20 customers here, I got 15 customers, when I put it together, I only get 25 customers. How does that work? Exactly. Multiple account holdings. Sorry, it came out a bit dark there, I can't see. So customers have multiple credit card accounts, and most of them have personal loan accounts too. Okay, we had to now deduce that because of what I said, but there's a few learnings here, and there's a few tips here. Single source is always best. Why? Because it's auditable. One of the things I hammer on in the Sakura team is single source, single source. Make sure that we know that that source is trusted and it's right. Then know the uniqueness of your record types and layers. Okay, and this is just an example that I quoted here. You could have a customer level. So a customer normally has a national ID or passport or something that identifies them as an individual. And then you have the product level, what products that customer hold, and then an account level below that, and a card level below that, and I can go on. There could be a regional level as well. Okay? So I think it's important that you need to understand this. So what am I doing? I'm pointing you back into your business and saying, listen, you need to understand your business better before you can even look at this data. Don't look at and I've heard the complaints. I don't have the data, I can't do this. I don't have the data, I can't do that. The data is defective. The data is not accurate. The data is, I'm like, yeah, but what can you do with the data that you have? Refine then, and I think somebody mentioned data governance. Refine your data governance processes. Say, this is what we would want to enable me to do the other things. Because if I had a magic wand and I could give you all the data that you want, what would you analyze? What is the business problem you would solve today with all the data that I give you? You will struggle with it. And the reason is because too much energy is focused on, I can't get the data, so I can't do anything, rather than I am the prize, right? I am the prize. So understand the related business rules, so multi-product holdings in that particular example, and then document it. That's the data governance thing. document these things and creatively explain. Why I say document is because I'm picking up this, in South Africa especially, it's become, a lot of analysts are being employed, okay? People with science, statistics backgrounds and that sort of thing. And they come in, they don't understand your business. They understand the data. They understand the stats. They can do bootstrapping and all these cool stuff in medians and means and everything, and you're like, wow, and graphs looks amazing. But what is it actually saying? So it's a great car, it's a great paint job on the car, but the engine is a bit defunct. Because you haven't empowered them with the business knowledge, okay? And that needs to be documented somewhere, typically policies, typically SOPs, data governance documents and so on. Here's another example. This is data accuracy, and it's not a real example, it's a made-up example. I can tell a joke about the number of dependents. Actually, there's a funny story about it. Are we happy with the period 2's distribution? So you'll see that there's a distribution between blank 0, 1, 2, 3, 4, 5, 6 plus, that's number of dependents. And there's period 1, which is, I think is pink on your graph, and then blue, which is period 2. And you can immediately see, when you look at this critically, there is some stuff don't look so nice. Right? What would you question? We just accept it? You're the manager, like, yeah, that's the number, you know, but single source comes from Sharief, it must be right. Because that's what we do, right? We look at people, we say, that person is great, it must be right. I'm like, no. Look at the content. So in there you look at what's different. Look at the field, number of dependents. How can number of dependents be blank? Should blank and 0 not be together? Do you know what I mean? And now you're going to say, but if number of dependents was a numeric variable, then blank can't exist. Because it starts with 0 and ends with 99, or whatever you defined it to be. So there can't be a blank in it really, right? The other one is obviously the 6 plus that stands out. And suddenly 6 plus. Now, I've seen finger trouble, right? Finger trouble people hitting numbers. And they hit the numbers on a record when they process, and they hit it in Excel is the worst. They just hit it at the wrong number. Suddenly, it looks strange. Sometimes it's a false thing. Yeah, it's not actually what happened, but I think it's important. And I think you're getting the gist of why we would interrogate data so much in terms of quality. What does a blank mean? Blanks and missings are areas for you to pursue and understand your business better. Now, understand whatever project or whatever process you have to understand it much better. So here's my top tips for this, right? Fully understand your operational processes, especially where data is captured or amended. Wherever there's data captured, understand those. Wherever there's data amended, understand those. I'm not even talking about data sharing yet. When you get to data sharing, it's a different story. I'm saying this is within your own domain, within your own business. Understand categorical and continuous variables. Okay, I'm going a bit statsy there. But basically what that is variables that have categories. Say like male, female, gender as an example is called a categorical variable because it has categories, male, female, or other typically. Or it's a continuous variable which is a number. Yeah, it's numeric. And when you have numeric numbers, you can group them. So I think the earliest presenter, there was a slide on they grouped, I think it was income levels. That's a continuous variable. So you can group incomes under 1,000, incomes of 1,000 to 2,000, incomes 2,000 to 3,000. You can group that together. Now, watch out for what's called outliers and strays. There's one record in your database where somebody captured 100,000 in income. And now you go, everybody 5,000 plus, and suddenly you think, oh, the averages are high there. It's because of the one record. Okay? So be careful how you class it. That means how you group it. It's important that you understand that. Now, your analysts in your business will know this well. They should know it well to identify that that's a problem. We probably have to correct it. Regularly check your distributions of key decision and business metrics. It's good practice. Check to see if you normally have delinquency at a certain level. Check that every single month. Okay? To see what that metric is doing. Understand missing and defaulted values. Sometimes IT people put stuff in and they default stuff. They say, you know what, I can't make this code work, but if I default this thing to minus 99, it works. And then they say, oh, that's great, let's all do it. And now I look at the averages. Why is this average negative? They put a categorical variable into a continuous variable field. Yeah? So watch out for those. It gets more fun when you roll up reports on a regional basis. No seasonality and business cycles. Okay? I've met a lot of people that understand seasonality. I haven't met so many people that understand business cycles. especially with COVID that's come in. Okay? But if you look at the business cycles that we're in at the moment, your portfolio will flow through a business cycle where there's stress on consumers and eventually they'll come out of it. Okay? They become resilient and it chows the next level of the pyramid in terms of delinquency. But you can forecast within reasonable accuracy where your portfolio is heading if you're talking at a strategic level. And then in terms of data relevance, is your existing data relevant or not? Okay, I don't think a lot of people ask them this question. They just say, no, but it has always been like that. I like that answer. It's always been like that. It's like, but it's your job to question it, isn't it? Anyway, so if you look at South African context, we used to have, just as when I was doing credit in a store, home telephone number, work telephone number was a big thing. We need the home telephone number, Sharief, we need the work telephone number, and I actually filled it in for the customers, and we did this, right? Where we are now, cellular has taken over, so fixed line operators is not really that important now, or having a fixed line. Then it became important, but if you have a cell phone or a mobile device, is it prepaid or is it contract? That then became the next best thing. And this is the same field, by the way. Okay? And then it says, no, hang on, now we need to look at location services. Now we're going to look at where this person is in Johannesburg, in Sandton, is in Randburg, wherever. And now it's going usage patterns. How often does he use it for data? How often does he use it for this and that? That's becoming more important now. And I'm saying, what next? So if I had to ask my 18-year-old son, he'll probably tell me what's going to come next on this. All right? Which channels do you subscribe to now? You know, what is the common stuff that you go look into, which websites and how. That is now probably where it's going to go, and it's just going to evolve. So you can ask yourself now, 2024, would we ask for a home and work telephone number, and what emphasis would we put on it? None, probably. People are working from home, there's no work telephone number. If I had to ask a scorecard person that developed scorecards on telephone numbers, and it was predictive back in its day, would you use those now? No. They've lost their predictive power. There's other kids on the block from a data perspective now that we need to look at. We track key variables over time, including credit scores. So I know we spoke about credit score, and I just gave an example of all those people that was lined up, and they had a rank there, which you can loosely say it's a score. But basically, if you look at it like that, track your scores as well. It's so important that once you put a scorecard in, that you track it. Your scorecard will lose its power over time, because the immediate past is not going to remain like the immediate future over a period of time. So you need to align it or redevelop it. If you don't have the right data for informed decision making, create it. I spoke about this earlier. And what you do is you combine the best brains in your business. You combine the commercial thinking and the credit risk understanding. There's clever people there. The business process experience, your ops people. And the data analytics experience. Those clever guys that study stats. Bring them all together, and then you say, I've got this problem. I need to create data that will give me that. But you need to define the problem first. Don't just bring it together and say, make it work. It's not going to work. They don't know where to go. So give the leadership. Consolidate financial risk consumer behavioral information to understand acceptable risk return thresholds. That's a big statement. Tell them that's a big statement. If you think about financial information, which is what? Interest, fees, revenue, costs, right? And you bring that together with consumer information, demographics, behavior patterns, spend patterns, ATM withdrawals, usage, complaints, and behavioral information. How much times did you withdraw? How many times did you go delinquent? What is your utilization on a product? Okay? You bring all that together, and then you can understand, if my customers do this, I will get that. Customers do that, I'll get this. You can start building these relationships in a bit more easier. And it guides your decision, like I said. It's not going to be a silver bullet, but it will guide your decision. And then where I think a lot of analysts are going now is with what they call optimization techniques, where they actually set a goal variable. So they say, I want to minimize my impairment in the COVID crisis or in this economic cycle we're in. I want to reduce my impairment, but I want to grow 5% my business. You can do that now. The technology exists. If you've got the data, you can do that. And you can set the thresholds along the path, and you can test it as you go. Track the results I'll always put in. And then consider champion-challenger approach, which I spoke about, run different tests. And this is basically the conceptual understanding of champion-challenger. You create representative test groups that are statistically random. Okay, there's ways to test it. You can even use a random generator in Excel. Decide the policy you want to test. This is important. This is more important than creating the random group. The random group I can create within a second. To decide what we want to test, we will fight over that for 2 days. What do I want to test? I want to test take-up. I want to test the right limit. I want to test delinquency roll. I want to test reduction in impairment. What is your goal? Define what that goal is and then we test it. Now, what I've come across in my life is there's two types of things that you test. You either test an action or you test a completely different selection. A different selection. So what I mean by that is if I have two random groups, people that's similar, and I do different actions on them, the result over time will be as a result of the action I took on the one and not the other. Right? They also have holdout groups where you take no action. So you say, if I don't do this, this is actually the result. So you know when you get that nasty question in the board and they say, but Sharief, if we didn't do this, we would have still been fine. You say, no, if we didn't do this, this is the result of that test group. We didn't do anything on them. Right? Or it's a different selection. So you do take a different set of people, but you do the same action on them. So for instance, here's a silly example. I will take a group of people that is very good risk and a group of people that's just on the cusp, they're medium risk, and I increase their credit limits by $100. Okay? And I can track their performance. And it's because of the group I selected. The profitability I make off it will tell me that's the right group to make more profit of. You'll set the KPI, decide the test appetite. This is always nice and fun. You want to test on 5%, 10%, 20%. Nobody tests on 50%. Okay? You always have somebody who says, I want to push it more. You say, no, first let the results build. The size of the test, the timing of the test. You can even test. I know that some people tested over COVID period. They also tested things like payment holidays. They tested actually to say, we're never going to have this again probably in our lives. Let's just test if we do a forgiveness policy here, where you have a payment holiday for these customers and not for the others. And they actually ran 2 tests, and they got the results out, and they could prove that what they did for those customers were actually better. Do you know what I mean? And if it was worse, it's okay. They learned from it. The duration of it, how long are you going to run the test? You can't run the test for even a day. Okay? So depending on when the credit life cycle you're testing and the scale of it, how big do you want it to be? And then you deploy and you track the results. Here's an example of a increasing customer spend test or champion challenger. The champions, okay, the name champion challenger comes from boxing. Okay, so champion is the reigning champ, your existing policy of how you do things, and the challenger is the one that you're testing. Okay, so in this case, we had a normal policy that says there's no incentive for our customers. They just spend the way that they want, as they want. Okay, but they've got a line of credit. The other one says we're going to put an expend incentive on top of them. So you have a representative group that I'm going to put an incentive on. Could be airtime, could be if you spend up to this level, we're going to give you more, or I'm going to give you free insurance, whatever it is, or lower fees, or that first spend, I'm going to waive the interest for that first month, whatever it is. And then you track it over time, and that's then how the groups build. The M at the bottom is the months. You'll see that they're together on M0. Why? That's the point of deployment. You can't have a bias already on the test. They must be similar. That's the definition of a random. So they all spend at the same level, and then suddenly you start seeing the blue group, which is the challenger group, moving out, the test group, if you want to call it that, and they're starting to spend a little bit more over time. Sometimes if you have a large operation, it takes time for this to take root, and that's why I would recommend you go regional if you have a large operation. Go into certain areas to prove the concept first, because you can still refine it. Okay. Going on with data relevance, bureau data was mentioned throughout the conference so far. Especially payment profile data is generally stable, and model expected credit performances very well. Actually, in this market, it has done that. It's done that in other markets as well, especially payment profile data. But what I want to leave you with is why. The why is because the data is stable and consistent along a single layout. If the data was not consistent along a single layout, you can't make that inference. So you've got to try to get it as stable as much as what you can. And I know it came up in previous discussions as well, something I want to talk about a bit later. But alternate, unconventional data, I call it unconventional because it's not the conventional credit risk stuff we look at, but alternate data is not a silver bullet, and you must test it. Test it if it works in your environment, if it does make the difference that you expect it to make. The right data enables better and more comprehensive business and consumer and customer understanding and better strategic insights. It's important to also know whether your data is static or dynamic. Static meaning it will never change. So when somebody applies for credit for you on a bank card product, that data won't change. It'll stay there, right? Stays there. So if one of those fields are income, that was the income that was declared 5 years ago because it's now 5 years on the account, right? So you got to understand what is static and what is dynamic. Dynamic is things that change, like the update from the credit bureau last month. Dynamic, it'll change again next month, right? Scores change every month, and whether it's forward or backward looking. Yeah, okay, I'll wrap it up now. Then review your KPIs and targets, but stay true to the cause. Okay, this is what one analyst told me. This, he says, if you interrogate the data enough, it will confess, meaning that you will make it say what you wanted to prove in the boardroom. Okay, don't become one of those. Stay true to the cause. This is a credit life cycle. I don't have to step through each one of those. It's based upon a revolving card product, typically a bank card. Those are all the areas of decision making. So at the moment, if we had to launch a bank card now here as a group, we would have to look at all these things and how we manage it. Who do we approve in new accounts? Who do we authorize the transactions on? Who do we statement? Who credit limit or credit line do we increase or decrease? Do we reissue a card upon expiry? Nowadays it's virtual cards as well. That's why the asterisks. Do we reprice certain people? Gold, silver, platinum, black and all that? Who do we market to? Who do we take account queries from and service better? Who do we manage in early stage collections right through to write-offs and dormancy? So I think these are all some of them. I'm not going to step through all of those, but those are all the things that you can look at. Policy rule sets, segmentation trees and rules and everything else to make decisions within a portfolio of this nature. And it is completely fueled by data, completely, because you don't know what you don't know yet until you look into the bottom of the or into the engine room. And of course it can be automated. So my closing remarks: top quality data gives you top quality decisions. Ensure data remains accurate and relevant. Okay. Typically the best strategies combine the best of breed business practice with your data evidenced ones. Okay, they must dovetail together. And stay cognizant of changing conditions. Conditions will still change for this market. It has to change. Yes, the interest rates are going to come down eventually, but it will. And the data opportunities created from it. If somebody was resilient through this process, it tells you something about that customer. Okay, so I'll wrap it up there. If there's any questions, I think you can just shout. Thanks.
Any questions for Sharief before we let him go? Okay.
Hey?
Thank you very much, Sharief. A very informative presentation. One of the issues we'll be discussing before the end of this week is that the regulators are beginning to be concerned about credit scores and transparency around credit scores and how consumers understand how they work and how possibly they can be abused in terms of discrimination and so on. And when I look at what you are presenting, it's a very robust process, time-sensitive process. The National Credit Act anyway allows credit providers to develop their own credit scores, obviously within certain limitations. So maybe to prepare the presenter, I'm putting you on the spot. Because you represent the private sector, what is your view on regulators intervening in that process and prescribing how it must work?
Okay. I think, can I take this out? Okay, so I think from the bat, okay, it's all about the consumer. None of this will exist. None of this will exist without the consumer, right? So the consumer is king. So we said it a couple of times, the data belongs to the consumer. So consumers have a right, in my view, that they must understand how their credit is being reflected at the credit bureaus. Correct? Right. How we reflect it, how we choose to reflect it, may be a score, but it may not be. It may be a grade. I've seen in some of the banking apps in South Africa where they just have a dashboard on a car, right? Like a rev counter, and it goes from red to green, and then it says you're okay. There's no score shown, right? But what you can do is you can inform consumers and educate them with respect to what they need to do to change the rev counter to become greener, such as pay your bills on time.
I'm talking about the underlying
Yeah, well, I'm getting there. So what I'm saying is, the underlying, I don't think you should necessarily go there. Do you understand everything in your car that goes on when you start it up? You don't. You just say it works, but you look at the rev counter. So what I'm saying is, and it came out, I think the gentleman at the back spoke about, how do we take transactional data from a daily basis? It's so voluminous, it's a lot, whatever. You aggregate it. That's the answer. You aggregate it. On Sakura today, from that 56 million records that exists, yeah, how many transactional records exist? Millions, if not billions. Did Sakura ask for that? No. That monthly roll-up information or aggregate information is the basis, and a solid basis enough to give you the risk differentiation. So it is a bit of a strange phenomenon in that we say you don't want consumers to be unfairly discriminated against. Statistical science says we're trying to find the points of discrimination in order to differentiate a good from a bad customer. You see the dichotomy. But they're not necessarily in competition with each other. They're serving different purposes. So really what you find in regulations, things like gender, your lineage, your religion, cannot be used against you in a scoring model. So if you park all that stuff to the side and say, okay, fine, we're compliant with the data we use. Now that we have the data, repayment patterns. If a consumer's repayment pattern is not good, he or she must be told it's not good. He or she must be told how to improve it. Read the statement. Understand what the statement says. Now, I can give you different variations of the same thing. Total due, installment due, past due, current due. They all mean the same thing, depending who you ask in the industry. So we need to settle on certain things that we educate the consumer with. Because at the moment, the consumers are flooded. So the consumers ask it this, and I've listened to phone calls. How much must I pay? Simple question. 200 Rand. Yeah? She doesn't ask, what's the installment? She doesn't ask, we've got to listen to consumers and reach out on the education basis to say, this is how it, the answer is aggregation and the way we present it back, but then that can be a standard, I think. I think that's the standard. I don't think necessarily you want to get into the characteristics of a scorecard. I'll tell you why. Typically, scorecards are built of 12 to 15, it can be 12 to 15 characteristics per scorecard. I don't think ABSA cards, as an example, have one scorecard. A bank typically have segmented scorecards, so they might have 15 scorecards. Now you need to, for each one, explain. And then also ask yourself, how empowered is the consumer to change that stuff? If I'm using a scorecard that's using historical credit bureau data, the consumer can't change it because it's historical credit bureau data. Do you know what I mean? So I think it's important that we keep things very simple when we educate and say, your credit score is a reflection of your credit profile. It says how good you are maintaining your repayment in a general sense. And if we look at it, you can get the detailed breakdown. Consumer in South Africa has the right to get the detail of the credit reports, all the trade lines. But the credit score is the aggregation of that. It just says, if you add it all together, and unfortunately it's a number now, yes, so we can't say you are green. We can't say you are light green. We say you are a 702. Okay, and then people are, what does the 702 mean? So I think it's difficult to explain what the score in value is, but we have to make it far simpler and we educate. So if you want to regulate it, I'll say regulate it along those lines, but it's got to have consumer clout, education must be built in, and it must have simplicity in explanation.
Thanks, Sharief. We have one more question here.
I am Duncan. Yeah?
Hi, Duncan.
I think I have two questions. The first one is, let me give an example. So for example, in Kenya, our group, we have almost 60,000 customers coming in every day, opting in every day. And yes, we've automated the process of making the decision on credit limits, mainly using alternative data.
Okay.
But then there is a proportion of customers that normally have missing data. And that is a problem statement the business keeps bugging me with, yeah? How can we increase the accept rate? Probably using other models like psychometric scoring. So my first question is, have you ever tested psychometric scoring in trying to reduce time to access credit?
Yeah.
Yeah, that is my first question. And then on my second question is, I noticed in Africa, my second question is more regulatory, yeah?
Yeah.
In Africa, I think in total, I've researched and I've not seen a proper model risk management framework. By model risk management framework, I think it's almost related to what she was asking, yeah?
A regulatory framework.
Yes, how the regulator, looks at the models and all that. I think the supervisory letter, for example, for us at NCB and Loop DFS, the framework that we use is the Federal Reserve of US framework. The supervisory letter, I think 11.7, model risk management supervisory letter. Do you think we should adopt the same practice, probably in South Africa, in Africa in general? Yeah.
Okay. So let's take the first one. The first one is on missing data. So I can give you some tips on missing data. Clearly, you're having missing data items because your consumer is saying, I don't want to answer it. Or the options you're giving her to answer is not the right option for her. So what it does mean, if you look at the distribution, that your missings has a certain number of people that fall in there. What you need to ascertain is, how is that group that's giving you missing information performing against the other groups that are not giving you missing information? Does that make sense? Right? So if everybody else is okay and you can see, okay, this is my red ones, these are my amber ones, and these are my green ones, where does this missing group fit in? If they fit in like the green group, then they are green, they're holding out on you. There are consumers out there that says, I'm not going to give you this information because I don't feel comfortable. Income information, sometimes consumers don't want to give it. Or they put a lower number. And other consumers on the other side will put a higher number in the expense column. So you need to be, or a lower number in the expense column. What you need to know is you need to be able to at least analytically prove that is actually better. That is what I think you should do, okay, in this circumstance. Depending on how big that problem is. If that field is a critical field you're using with, and you've got missing in there, it's not good. Because there's something happening in there and you don't know what's happening. So my first thing is get under the bonnet, understand what's happening there first, and what that missing performance is. The other thing what you can do is grab a sample of them, phone them, contact them, ask the consumer. We asked this question, but you chose not to answer it. Why? And you might find that you have to make some process changes to allow that in and track that. But missings you'll get. Okay? You're going to get it. It's part of life. As long as it's part of your knowledge of understanding how you run your portfolio, then I don't want to be scared about missings. I think it just points to something that you're not on top of. That you need to say, my business don't understand it, I don't understand it, makes me feel uncomfortable. I need to analyze and deep dive into it. The regulatory framework, I'm not familiar with the regulatory framework that you're talking about with the model development. The only regulatory frameworks I'm familiar with is mainly with provisioning and impairment. So under IFRS 9, there's some model development protocols that they've proposed that some of the larger companies here have adopted. There's huge write-ups on it on the financial statements. But it's mainly for impairment monitoring, not so much for scorecards and credit. Remember, the scorecard doesn't make the decision, eh? So make it very clear. When I ranked those people up there, when I had a list of people up there, they had a number on them, yes. But I didn't say you need to approve or decline. Because what you're doing is you're just scaling it. The scorecard just ranks them. They have a number on them. You, as the business, must decide what is the minimum threshold for acceptance based upon your strategy. So I think if it's model development where basically everything is auditable, your data sources can be traced, your data manipulation that you use in your scoring. For instance, if you transform data, that can be, it's strongly governed and you can sense check it. Remember, you can code things differently, right? I can code things where I transform data. I can code it another way to check, to see if you coded it correctly. And be guided by the output. So when the output comes, look at the output and say, if I made all the M's Q's, there should be no more M's in the final output. Then that's what you store away and you document it up. I don't think any auditor will find a problem with it because you've shown the starting data set, the end data set, the result, and the transformation, which ticks all the audit boxes, and then they will be fine with you. So I don't think they'll be. And what my experience is also, auditors don't know the detail of scorecards and scoring developments. I haven't seen regulators, with all due respect, climbing into that discipline either. It's very difficult. You can't be legally trained and statistically trained. It's very disciplined. So I'm like, I'm not sure if they can actually lay down the foundation for it, and that's why I'd rather go with the financial gurus on this one. IFRS is probably the best in saying there's a view of how you should do your loss given default, or your, whatever other statistics you're looking at from an impairment perspective. But no, I haven't seen it actually work, and I don't know what purpose it serves. I don't know this. I'll be honest with you. If there's regulations imposed on me, I would want to know what's the purpose behind it. If you're checking to see that I'm reckless, great. If you're checking to see that my models are stable, and I'm like, isn't that, because here's the other thing. If the models don't work, you'll suffer a loss. If you approve the wrong people, you'll get losses, you'll get bad debts. We haven't spoken about the bad side of it. But yeah, if you get the decision wrong, you'll suffer some losses. Then you don't want to be audited on that. Trust me. So I don't think it's plays in the regulatory space. I'm actually very surprised that there is something that exists. Does that answer your question? Sorry, I want to make sure. Okay.
Fantastic. Thank you so much, Sharief, for sharing your expertise and insights with us.